Wailun, the moderator for today's session. The COVID-19 has not just affected the ways we live, work, and learn, it has also caused distortions to the world economy. In just 2 years, we have witnessed the impact of helicopter money, the capital market boom and crash, oil price from negative to over $100, and a 4 decades high inflation. Today, we are delighted to have 3 panelists with us to discuss on the normalization of economy and the engine of growth moving forward. Before we start, let me introduce our panelists for today. First, we have Mr. Dan Gan Leong, a fund manager from CAF Investment Bank. Mr. Dan graduated with a Bachelor of Business, majoring in Economics and Marketing from Monash University, Australia. He is a CFA holder and also a holder of a Capital Market Services Representative license, also known as CMSRL, to carry on the regulated activity of fund management. He joined CAF in 2013 as an investment analyst, tasked with research responsibility for both the Malaysian and Hong Kong market. Prior to joining the company, he spent several years working as a business development executive in the manufacturing industry. Secondly, we have Ms. Nurul Farhana binti Noor Saiti, a senior analyst from Phillip Research Sdn Bhd. She joined Phillip Capital Group in August 2015 as an analyst in Phillip Research Sdn Bhd. She performs unit trust, ETF, and equity research that include constructing model portfolios. The UT universe includes in-house and third-party funds, including local and overseas mutual funds. She is also leading the team to provide research report for local ETF under the Bursa ETF research scheme and developing in-house quant project for stocks and also macro models. She also participated closely in the development of ETF for conceptualizing, designing, and finalizing the index while working closely with the chief strategist. She graduated from Temple University, Fox School of Business in US with a Bachelor in Business Administration, major in Actuarial Science, and minor in IT, Innovation and Entrepreneurship. She holds a CMSRL license. Lastly, we are grateful to have Mr. Tan Ji Tun from RHB Asset Management Singapore. Mr. Tan Ji Tun joined RHB Asset Management Private Limited in April 2018 as a Chief Investment Officer, where he is responsible for setting up the investment and research processes, team structure, investment strategy, and product strategy for the regional equity strategies. He oversees the Asia-Pac regional equity team responsible for managing the different equity and multi-asset mandates. Additionally, he is a lead portfolio manager for key institutional and flagship retail equity and multi-asset portfolios. He has over 24 years of experience in the investment industry, managing multi-billion regional Asia-Pac equity and multi-asset portfolios on behalf of sovereign wealth, pension plans, endowment, insurance, and retail clients. Prior to joining RHB, he was with Wellington Management, Aviva Investor, and Mandi. He was also the Mercer Investment Consulting as a manager, researcher, and investment consultant to various Asian-based sovereign wealth, pension, insurance, and institutional clients. Mr. Tan holds a Bachelor's of Business from Nanyang Technological University, majoring in Applied Economics with a minor in Banking and Finance, and has been a CFA holder since 2002. Without further ado, let's begin our session today with the hottest topic troubling investor this year, the inflation. Here comes the first question. The US CPI reading released last week was 8.3% year-on-year, beating the expectation of 8.1%. The market has reacted negatively since then. Probably we'll start with asking Mr. Tan Gan Leong from CAF. Do you think the CPI data in US has peaked? If so, could you provide us with some data or evidence?
Okay, so hello everyone. Thank you for having me here today. I think that I personally believe that the headline numbers may have peaked. But the key focus here, I think, is most people are looking at is the month-to-month increase and decrease in inflation numbers. Because if you look at it from a year-to-year basis, then if you got a lower base last year, then you will see a very big headline number. But on month-to-month basis, right? So I think the core numbers we are seeing, inflation still going up about 0.6%. So it's higher than what the consensus expected, which actually resulted into the sell-off that we saw right after the numbers came out. Despite headline numbers, actually, if I'm not mistaken, it's down about 0.1% on a month-to-month basis. Now, the disparity or the divergence in the numbers between the headline and the core numbers are mainly because the core numbers exclude energy and food prices. So on the month-to-month basis, I think we saw a significant decline in gasoline prices. It's in tandem with what we're seeing today in oil prices. As you know, oil prices have fallen to now about Brent, I think it's $90 over. So, we saw the divergence there. But nevertheless, we do believe that, going forward, sentiment have turned weaker. I think you have listened to news where, the big guys are cutting back. So we should see a weaker month-on-one numbers going ahead. But that's what I think.
All right, thanks, Kan Leo. Ms. Farhana, how about you? What's your view on this?
Okay, when it comes to the headline inflation and also the core inflation, right, when we look into the numbers of the disinflationary forces that we've seen so far, we do see a lot of all these components, right, that are facing the good prices, which includes like easing supply constraint that we have seen throughout the COVID period. Even after that, we still face some supply constraint due to the China zero COVID strategies, right? That on top of that, like Mr. Tan Gian Liao already mentioned just now, gas prices also coming down, so that also lead to the lower transportation costs. And on top of that, with the we see a lot more stabilization when it comes to trade, especially on the shipping ports, right? So we see falling on the import prices as well. But however, when it comes to the component of the owner's equivalent rent inflation related, that component is still accelerated. So that actually the component that underscores the high degree of stickiness when it comes to rent related components. So that caused the core inflation to actually still maintain to be on the accelerated path for August compared to July. But for now, on my side, we actually expect the sticky CPI to peak in December, as we have earlier shared before, that we seen that when it comes to the flexible CPI, it will start peaking towards the end of this year's summer. So when it comes to the relationship between sticky CPI and also flexible CPI, we see a trend of sticky CPI to have a 9-month lagging, sort of like 6 to 9 month lagging impact compared to the flexible CPI. So as we already have sort of like seen that flexible CPI start to peak by year end summer, so that's why we expect the sticky CPI component would be peaking by this December.
All right, thank you, Ms. Farhana. Let me go deeper on this. We know the component for CPI, the highest rated one is the CPI shelter, which is about 1/3 of the CPI, and that value was 0.7 month-on-month. But there are some other sources like the Zillow index and also the apartment list, stating that the rental ask price has actually gone down. Do you mind giving some input on this?
Okay, yeah. Regards to that, based on our checks as well, when it comes to inflation data, right, it's very, very diverse to a certain degree, because when you look at the rent prices, those that is within the city, there is some some deceleration when it comes to the rent prices. But then for the outskirts, sort of like outside of the urban side, right, they do face some high degree of rent related some impact on when it comes to inflation on their rent. But then moving forward, we think that when it comes to inflation impacts, right, so for now, the biggest culprit of the inflation is essentially on gas price, right? So especially for US side, when it comes to those people that live within the city areas, right, they're actually not that impacted when it comes to gas prices, because most of them actually use public infrastructure. But those that live outside of the city area, those that commute to their office, actually that's one of the main reasons why the inflation actually killed off. To a certain degree, it sort of like slows down the economy, because to some people, the cost for you to go to work is essentially the same as what you get for the week. So it doesn't make sense for you to actually go to work. But as gas prices continue to go down, then we see Brent prices also start to stabilize. So as that component start to come lower, so as I mentioned just now, the relationship between the sticky and also flexible CPI, if it holds, then sticky CPI would probably peak in this December lah.
All right, thanks, Rana. Mr. Tan Jitun, how about you? Same regarding the same question. What's your view on this?
Okay. First thing first, I would like to thank Phillip Capital for inviting us today for this panel session. Okay, going back to the question, I think like what my fellow panelists, Gan Leong and Farhana has mentioned. So I do think that for the headline CPI, I think it's quite clear that oil prices has come down quite nicely from the high of 130 that we saw immediately post the Russia-Ukraine war. Now it's hovering 80 plus 90 handle. So I think that's certainly very comforting. So you can see that being reflected in the headline numbers coming back down. And like what Gan Leong has mentioned, I think the year-on-year comparison has also made it a bit easier going forward. So I think similar to what my fellow panelists have mentioned earlier. So I do think that definitely for that component, we should have seen a picking up. And in fact, that will start to trend down quite nicely. But I think for the US in general, I think what I think is catching a lot of economists, US-based economists and strategists, even them by surprise, is also how the core portion, right, have been a lot stickier than what they have expected initially. So that's why you see the huge reaction in the stock market when the numbers came out in terms of the CPI just last week or so. So that tends to be quite a lumpy, and it tends to be quite volatile as well. So that's something that we have to watch quite carefully. I think it's important also to highlight that we need to make sure that that doesn't become structural in nature, right? So what we have been talking about, I mean the central bankers have been talking about transient inflation for previously over the last few quarters before changing their tune quite a fair bit. So we have to make sure that that doesn't get embedded into expectations going forward. But if you look at the 5-year long-term inflation expectation, that continues to be quite well contained. So I don't think the inflation that we are seeing right now is structural, but that remains to be seen. So but we are hopeful. I think like what Farhana has mentioned, hopefully with the loosening of restrictions all over the world in terms of ports, in terms of supply chain, that should help to filter through to the CPI numbers. So we are also hopeful that going to next year, we should see both headline as well as hopefully the core inflation number starts to temper quite nicely as well going into next year.
All right, thanks, Mr. Tan. So it seems that we agree that we are still cautious on the inflation outlook near term, but CPI might not normalize sooner than expected. So do you think it will continue to wait on the market? Mr. Tan Jitun?
Well, I think if you look at the share price reaction last week, so you can see that any surprise, right? Any surprise uptake would definitely cause some market reaction, because I think that is a reflection of how nervous the market is. I think the market is obviously worried about CPI, but the market is also worried about quite a number of issues as well, from the Russia-Ukraine war, that obviously is one, to what's happening on the geopolitical front, not just Russia-Ukraine, but also the relations between US, China. Also, there are quite a fair bit of things that the market have to contend with. So the market certainly will react if there is some perceived bad news. However, I also want to highlight that it has been quite a while that the terminal Fed fund rate has hovered about 4+%. Right now, it's probably 4.25 to 4.5%. Terminal rate that is supposed to be reached the peak and in March of next year. So that has more or less been quite stable. But previously it could be 3.75. So that has come up a bit to 4.25 or to 4.5. So we don't see a big upgrade in terms of the terminal Fed fund rate. So I think that should be quite comforting to the market. So in short, I do think that quite a fair bit of this concern has been priced in by the market, right? And in fact, I think the bigger question would be how long would the terminal rate of, let's say, 4.25 to 4.5 last? And when would we see a bit of a softness in the market that would necessitate some form of rate cut, right? So this is a conversations that we are probably going to have coming into the end of this year, maybe going into next year as well, as the market starts to soften quite a fair bit, or especially the economy with the aggressive rate hikes that we have seen over the course of the last few months.
All right, thanks, Jitun. Based on Jay Powell's speech at the Jackson Hole Symposium, the Fed signaled that there will be another aggressive rate hike to combat high inflation, and market has since fully priced in a 75 basis point hike, and there's an 18% chance for a supersized 100 basis point hike. And after the speech, Malaysia has actually already rose rate by 25 basis point on the first week of September, which is widely expected by the market. So what's your view on this? Do you think we will have another rate hike in November? Gan Leong?
Hi, yes. So basically, I think it's now consensus view that the Fed will increase the interest rate by 75 basis points in the meeting, I think today, right, on the 21st.
Yep.
And then there will be 2 more meetings ahead. I think a lot of people are saying that right now, highly likely that, we will end the year, with rates above 4%. I think now the implied rate is about 4.2% by the December meeting. And then, as mentioned by Mr. Tan earlier, that the terminal rate, which is where people try to predict how high the interest rates in America will go to, is at about 4.5% right now, which is about March next year. Now, from our standpoint, if it does go to about 4.5%, it will be largely negative to the markets. Simply because, to begin with, Malaysia's interest rates right now is at 2.5%. So there's a huge interest rate differential between the Malaysian rate and the supposedly risk-free rate. Historically, the interest rates in US are considered as risk-free rate. So that interest rate differential will likely result into a sell-off in your currency if if it continues to widen. And that's what we're seeing in Japan right now, which why we saw yen falling more than 20% against the dollars, because the Japanese bank have stuck by its low interest rate environment. And so in Malaysia's case, I do believe that they will have to increase rates. Question is, are we capable of increasing, or at least at the rate that America or the US Feds are increasing? And if we could not do so, we are likely to see ringgit depreciate further from now already 4.52, which is already one of the lowest levels that we've seen in decades. And that will be quite bad for our markets in general. Actually, it's quite bad for equity markets globally. I think recently Ray Dalio mentioned that if they were to go on with the rate hikes and if they were to raise rates to 4.5%, there's at least a 20% downside risk to equity markets at this juncture. So we think that US Feds will increase. We think that Malaysia will try to increase, but we do not think that the Malaysian market or economy can actually accommodate such a rate hike, and which we're likely to see, our currency being sell, which is actually very bad for emerging markets in general as well.
All right, thanks, Mr. Tan. Jitun, how about you? Do you think it will be a 75 basis point or 100 basis point hike tonight?
I think 75 is baked in. So in fact, I think in November as well, I think probably 75 is probably going to be the likely one. Like what Gan Leong has said, probably 4%+, 4% is more or less priced in. However, I do think that right now with the Fed Fund futures already pricing in terminal rate about 4.3%, right? So from my perspective, at least, right, quite a fair bit of this should be priced in by the market, right? So in the Fed Fund futures is something that everybody can see. You just open up your Bloomberg and you can see that. I'm sure the fixed income markets have reacted accordingly. They know what is the yield curve, how does it look like. And I think same thing for the forex market. I think it's going to be soft in general, ex the USD market. I mean, that's for sure. Looking at where the interest rates are going, but however, I do feel that quite a fair bit of this should be quite well known to the market, because we do have the yield curve across all the different countries and regions that are easily that can easily be analyzed, right? So I'm hoping that quite a fair bit of this should already be priced in by the market. But nevertheless, right, the short-term knee-jerk reaction to the market could still be quite negative. But having said that, I think for us as investors, I think it's important for us to look forward. I think where the market is right now, what Fed Fund Futures is looking at, I think that is really quite well priced in. So what we are looking for, at least for RHB Asset Management side, is to try to look forward, right? So what is going to happen just around the corner, right? We just need to go past the corner, go past the whole volatility that we are seeing over the course of the next few quarters, and then what next, right? Are we going to see how soft is the market going to be in the US? I mean, some people are talking about recession. Our view is it's probably going to be a soft landing. A recession or not, I think that remains to be seen. And hopefully, if the Fed does it well, they can hopefully skirt it, right? And in general, you can see how different parts of the world are reacting based on the kind of scenario, but I do feel like what Kan Leong is saying, right? We do have to watch out for the FX market, because I think the interest rate differential does have quite a fair bit of impact on the fund flows.
Thanks, Jidun. Talking about rates, China has recently cut its 5-year loan prime rate by 15 basis points to 4.3%. From 4.45%, and lower its 1-year loan prime rate by 5 basis points to 3.65%. Ms. Farhana, what is your view on this? Farhana?
Yes. Sorry.
Did you get my question?
China cuts their 5-year loan prime rate, right?
Yeah.
So essentially, this one we have seen, especially throughout the COVID periods, right? Especially throughout the lockdown periods, right? Their economy is essentially suffering, especially on the loan side and also their property segments, right? We do see a lot of slowing down from there. So the cut is trying to boost up that part of the economy, but then at the same time also they do want to save quite a number of their SMEs as well. So rather than having all these company being closed down because of Xi Jinping zero COVID strategies, right? So it's better for them to actually cut the loan prime rate, put liquidity into the market, so that at least all this company can still survive through, like, essentially. Then we also have to remember that towards the not towards the end of this year, actually is next month, Xi Jinping is up for an election, so his focus is actually more focused towards that, to essentially make everyone happy before the upcoming election.
Yeah, thanks, Farhana. Jidun, what is your view on this?
Yeah, I think that's something that totally differentiates China from the rest of the world. I think the rest of the world, like what our earlier conversation has been about, has centered around rate hikes and how aggressive these rate hikes will be. I think for China, I think they are doing the exact opposite, right? So like I mentioned earlier, we are talking about cutting rates in China. So I do think that that is one of the rare regions or rare countries in the world whereby there is some form of loosening and obviously some form of stimulus. Because the rest of the world, we are all talking about tightening, from QE to QT, interest rate hikes. Here in China, I think they are doing the exact opposite. So I think from a macro perspective, right? So I do think that for investors out there who are worried about what the world will become from due to this aggressive interest rate hikes, I think you can look towards China. So China is doing the exact opposite. So with the kind of stimulus that they are looking at, so I do think that makes China a lot more interesting. I guess not just on the monetary front, right? So they are loosening also on the fiscal side. Definitely they're doing more. I think like what Farhana has mentioned earlier, to try to stimulate the economy. Definitely the economy is softening, I guess, not just from the global weakness that we have seen, but also like what Farhana has mentioned in terms of the zero COVID policy. So that's that, and also I think more importantly, in terms of policies, right? In terms of their policies towards the Chinese internet companies, their policies towards a lot of other industries, we are seeing more relaxation, right? And also, I think for China, more importantly, would be their focus on the Chinese property market. So you can see, at least on the policy level, definitely they are loosening. They're making it easier for people to own houses even in provinces that you are not necessarily living in. So we are seeing all this kind of loosening across all the different dimensions. So I think that makes China a lot more interesting when the whole world is in the tightening mode.
Thanks, Jidun. Can we say you are overweight China and underweight US now, Jidun?
I guess, okay, so from our perspective on a global asset allocation side, we are a neutral US, but we are overweight Asia and in particular China. We are underweight Europe from the perspective that I think Europe is in for a tough winter. Russia-Ukraine war is just right at their doorstep, and energy prices are going to shoot through the roof. So sentiments, it's quite low, obviously, in Europe right now. So they are in quite a bad place, lah. But so relatively speaking, right? Relatively speaking, Europe being in such a bad state, I think US it's a lot more stable. So that's why we have a neutral position there. Whereas for China and for Asia, right, we are positive. Reason is because I think China, like I mentioned earlier, a whole slew of loosening measures that we have seen over the course of the last few quarters, and also for Asia in particular, certain parts of Asia, like for example ASEAN, we are seeing some form of reopening play, and that reopening play definitely gave ASEAN countries a leg up, right? We are seeing, like I mentioned earlier, a global weakness, but for certain ASEAN countries, the reopening plays are starting to see life, right? So, over the course of the last 2.5 years, I think ASEAN has been a bit of a laggard in terms of reopening, but we are seeing that change now over the course of the last few months. So we are also quite positive on that as well.
Thank you, Jidun. Our next question is on the China zero COVID policy. And we know that China has recently back on having strict lockdowns, where Chengdu is being locked down for its reported COVID cases. And of course, it's being lifted now. In your opinion, is China going to continue to adopt the zero COVID policy? If so, how long will it last, Farhana?
Yes, at least at the current moment, right, we see the zero COVID policy will probably last until the election in October. So since COVID happened, we do see that Xi Jinping has been advocating on the zero COVID strategy, even to the expense of China economy, right? But then when we look at Xi Jinping past behavior, and as he is heading towards the 20th National Congress of the Chinese Communist Party election on the 16th of October, on 16th of October next month, so it's unlikely for him to change his strategy at this point. But however, at this juncture, we probably will only have clearer pictures of the zero COVID policy until the election is over, because on the election side, it really depending upon the outcome of the election, because the main concern right now when it comes to that election is actually whether Xi Jinping is able to do a consolidation of power, to continue his consolidation of power agenda.
Thanks, Farhana. Gan Leong, how about you? What do you think about the China's zero COVID policy?
I do think I agree with Farhana actually, that I think that they are likely to stick to the stance of zero COVID. Simply because again, the party congress is coming up, they're not going to U-turn from that stance at this juncture. However, but if we see what's happening in Hong Kong, actually, slowly they are loosening how strict they are in these quarantine measures, allowing people to fly again. I think that over time, if they get enough mRNA vaccines for their people, because the thing is, China, unlike other countries, they had very little cases. So a lot of people actually did not get infected with COVID previously, so they didn't get that natural immunity. So it will take some time for to vaccinate a billion population, especially now they are, I think they are trying to get the mRNA vaccine to their people. When that happens, then I suppose they will slowly loosen up. But because at this juncture, if they continue with that zero COVID policy, it will be very difficult for the whole economy. Unlike previously, the previous few years where, they have been very reliant or dependent on exports. At this juncture, I don't think that they can depend that much on exports anymore to drive the whole economy. Because if you look at it, there's clearly a transition in spending from consumer goods and goods to services, which is something that China just cannot, even though if the renminbi were to continue to depreciate, which it is right now, I do not see it, being able to sustain that high export numbers that they've enjoyed in the past 2 years when they were running on the zero COVID policy. So going forward, I think it'll be a lot more difficult. So then, he have to weigh, presidency have to weigh what he needs to do.
Yeah, thanks, Gan Leong. Despite the relief of lockdown in China and the accommodating policy undertaken by the Chinese government, the Chinese market sentiment does not seem to turn good. What's your take on this, Jitun?
Okay, so I guess I would say that it's not only China, right? If you look at markets all over the world, I think people are trying to come to grips with quite a fair bit of volatility in the market brought about by a variety of factors. I think, interest rate hikes, obviously, we've been talking about that for the longest time. Same thing for, I guess, related to that, same thing would be on the inflation fears and also the geopolitical front, that it's going to be pretty messy, right? So you have Russia, Ukraine, then obviously US is in the mix there, then obviously China and US, so the world is worried about a multitude of concerns at this juncture. So I guess it's not only China that is suffering from this sentiment issue, right? However, I do think that unlike other parts of the world, China is in a fortunate situation whereby quite a fair bit of their own destiny is in their control. We have talked about the zero COVID policy. Our view, I think, similar to what Gan Leong and Farhana is talking about, is that probably nothing much is going to change from now till the MPC, and even subsequent to that, we're going to winter. So I think they'll be very cautious about that. And then we're going to have Chinese New Year coming soon once Christmas is over. So those are very sensitive periods if you look at the old Chinese calendar. So I think post that, probably we can see some form of loosening, but also, like what Gan Leong has mentioned, I do think that we should take it quite positively that Hong Kong is in fact loosening, because end of the day, if you think about it, right, Hong Kong, China, Hong Kong is part of China, and the policies that they have enacted over the course of the past few quarters have been pretty consistent with the zero COVID policy of China. So right now we are seeing some form of opening up on the Hong Kong front, right? So I think that is a precursor of things to come. I think the senior China leadership is also watching with great interest what is going to happen to Hong Kong, right? So if let's say they open it up in a controlled manner, and let's see the numbers of cases in Hong Kong, and more importantly, what will be the stress on the hospital system. So these are things that I think the Chinese government is quite well known for, right? They tend to do things in a very measured manner. I don't think they will swing from one extreme to the other and suddenly announce that zero COVID policy is over. I mean, that's not what the market is probably thinking about. But we are seeing some form of positive steps in the right direction. So I mentioned earlier, right? So not just that, on the zero COVID policy, we are seeing quite a fair bit of loosening on a variety of dimensions on the Chinese side, from monetary to fiscal to policy on the Chinese internet space. So we are quite positive that this whole slew of policy will provide a floor to the Chinese market. As you can see, some of the key Chinese internet stocks have traded quite nicely since March, when Yuhe came out and in strong support of the Chinese economy. So I think that provides a good base. So, but having said that, I think the world equity market needs to come to terms with the interest rate hikes that we are going to see over the course of the next few months.
Thanks, Jitun. Farhana, on this same matter, what's your view?
Sorry, on the zero COVID policy?
It's regarding the lockdown in China. Despite the relief of lockdown and also the accommodating policy, the Chinese market sentiment has not seemed to turn good. What's your view?
This one is still related to the what you call it, to the election in October. So essentially everything for us, we think that it's going to boil down to that actually.
All right, thank you. And we are seeing some of the big tech companies such as Apple are planning to look for alternative to their manufacturing factories. So in your opinion, do you think these companies will leave China if they continue to their current policies? If you are a Chinese policymaker, right, what will you do to retain the big tech giants in China? Jidun?
Okay, I guess we need to make the distinction between leaving China in general versus, I think, them allocating some resources away from China. So I think post the whole COVID situation, I think the world have probably come to a realization that obviously, the just-in-time kind of thinking in terms of manufacturing is obviously very effective, great for the companies. But like what COVID has shown us, right? I think the focus has shifted quite a fair bit from just-in-time to just-in-case, right? So I think a lot of manufacturers that we are talking to are probably talking about the China Plus One policy, right? So obviously they will continue to have their main base in China, but obviously they are thinking about just in case. What do they do if, let's say, we have a repeat of the whole COVID situation? What if there is some escalation of tension between US and China? What are they going to do? So a lot of manufacturers are talking about the China Plus One policy. So the Plus One is probably quite interesting. I think a lot of plus ones will probably be here in our parts of the world. It could be in Vietnam, could be in Indonesia, could be in Thailand or in Malaysia, right? So I do think that we are not going to see widespread migration of manufacturing resources away from China to other parts of the world. I think the main thing is also because that it's not so simple, right? Because end of the day, when you move a factory, it's not just about moving the factory. You have to move the entire ecosystem. The whole supply chain needs to move with you, right? So China has grown to be the factory of the world in decades, right? So it's not easy to unwind or to reverse that kind of situation. And also more importantly, China does have certain strengths, which I think will be hard to replicate in other parts of the world. And obviously the first and foremost will be just the sheer size of its workers, right? 1+ billion people in China, there's a lot of people who are willing to work in the factories, who are able to work in the factories. But if you try to move all that factories to other parts of the world, there's very few places in the world who are able to provide that size of workforce, right, to rival the size that is being made available by the Chinese population. So that's one key consideration, which is obviously the size of the workforce. And obviously, like what I mentioned earlier, the ecosystem, right? When you want to move, you have to move the entire village, so to speak. You can't just move one factory, and then the logistics part, we have to deal with the rest. And then that's not possible, especially when you're talking about the huge MNCs like the Apples of the world, right? So we know that, the parts comes from everywhere, right? They tend to have one whole village that tend to service a main contract manufacturer, right? So it's not so easy to just say, I'm going to move, and then they can move their factories out from China within a short period of time. So I do think China will continue to have its strengths. However, I do think that the plus one policy will tend to benefit countries in our parts of the world, which is in ASEAN.
Thanks, Jitun. Gan Leong, how about you? Do you have the same view as well, or you have a different view?
Yeah, so basically, I don't think these guys are getting out of China. It's more of diverting. I agree with Jitun that they're diverting their manufacturing outside of China. simply because, I think if you saw the data, right, the number of people working in manufacturing in China, right, have already peaked and it's coming down. Right now, I think I've recently read an article that, this year itself or last year, this year, more than half of the global new automation installation is actually in China. So China alone is equivalent to what the whole entire world, the amount of new installed automation lines. Now, the reason so is because the Chinese government have to push for automation, as the workforce is no longer growing anymore. So they need to compete with other countries, countries like Vietnam, India. Apple have already shifted. They didn't really shift, but they Foxconn started new factories in India. Hopefully, one day it can cater to the Indian market. But in general, I think that's what's going on right now. Labor is no longer cheap in China. So the only way the government is trying to combat this, or actually companies are trying to combat this higher salary or higher wages, it's by investing in automation. And that's what we are seeing today. And I do believe that eventually everywhere else people will also invest more in automation. Now, that will be a problem for emerging markets because historically, in the past, more often than not, we always look at, countries like Indonesia and India, for example, we always look at these countries have a large young working population. So it's a good place to start, where, MNCs or big companies will invest in building manufacturing facilities in these places, and because of the cheap labor, and then over time they will move up the value chain. But if if the large companies or MNCs start investing heavily in automation and no longer need to depend on cheap labor, then it will be very difficult for the emerging markets or smaller countries, like Indonesia, India, to actually move up the value chain or to increase the GDP per capita. So I see that, like I said earlier, I think how the Chinese government is combating this is by trying to push automation, invest in tech. That is one of the methods they're doing to try to refrain companies from diverting the manufacturing facilities elsewhere. But China is still one of the largest consumer markets in the world. The big firms will still want to be there. So I do not think that they will leave the Chinese market. It's more of the manufacturing side. It's diverted elsewhere.
Thanks, Ngan Leong. Fana, could you shed some light on this matter as well?
Yeah, actually, I agree with Mr. Gan Leong and also Tan Ji Tung when it comes to the manufacturing side. Right? Essentially, they can't leave China because the consumer market in China is huge. So, but the movement that we have seen so far, right, most of the factories, all these manufacturing sites, right, they are moving towards closer to the China side. So, if you want to bring back to the question as what if I'm China and what would I do to retain all these big tech giants to stay, probably my personal view is that I won't do anything, because for the past few years we have seen that China has picked up their pace when it comes to technology space, right? They already start investing a lot on it. They develop their own semiconductor industry. They also start to build up their capabilities, their technologies, their designing, their research up on the value chain when it comes to the tech space. So rather than asking this big tech to stay, what China have done is essentially build up their own technology industry space, essentially.
Yeah, thanks, Fana. And China also has stepped up its economic stimulus with a further 1 trillion yuan of measures to bolster growth and curb the fallout of repeated COVID lockdowns and the crisis in the property market, following the speech of China Premier Li Keqiang that urged for more pro-growth policies from the government. Do you think this stimulus plan is sufficient for China to support its economy moving forward? Jitun?
Okay. So I guess what I'm conscious of is that I think it's not just a stimulus plan, right? Because I think it's the stimulus is just one part of a whole slew of policies that the Chinese government are trying to push out. right? Definitely, like what I mentioned earlier, we have monetary side, we have fiscal side, we have also industrial policy side. So they are trying to make headway into all these different measures in order to support the economy. I think the economy is weak for a variety of reasons, and we have talked about it. Zero COVID policy is one, and also the general weakness of the global economy is also causing some concern, right? So I think the Chinese government is well aware of that, right? So unlike other parts of the world during the whole COVID crisis, they did not go in and try to, we talk about helicopter money initially. They didn't do that. Chinese central government and central banks were probably the only ones that did not have to print unnecessary amount of money. They did not have to overstimulate their economy during the whole COVID crisis. So that's something comforting. So on hindsight, obviously that is the best, right? So they didn't have to withdraw all that liquidity. So now that the economy is a lot weaker, I think what they're doing is actually running counter cyclical to what the rest of the countries are doing, right? So going back to your earlier questions, I think we need to look at the fiscal stimulus as one part of a whole slew of policies that they are enacting in trying to support the overall weak economy, right? So and like what I mentioned earlier also, I think we've talked about that. I think we are all looking forward to some form of modification to the zero COVID policy. But till then, I think whatever they are doing should be able to get them out of the big troubles that I think quite a fair bit of the markets are unfortunately expecting at this point in time.
Thanks, Jitun. As we know, the Chinese EV industry is booming, and the Chinese EV companies such as BYD is looking to build a factory in Thailand. What do you think of the EV industry, and how can the Chinese be the major player in this field? And there's been recent news that Sime Darby is in talk with BYD China for their distribution rights. What do you think about it for the Malaysian EV industry? Will be good? Will there be growth? Because as we know, the infra for EV, the charging station is still very early stage in Malaysia. Prana?
Okay, so for these questions, right, so essentially we need to take a step back to see how EV has been successfully, not just in China, so essentially on US as well, because the US part will be will be relevant to how Malaysia would EV market would move forward essentially. So for Tesla, for US market essentially it starts with Tesla, right? So when they first started the whole EV, essentially they first positioned it as a premium product, and it shows the capability of EV where it's able to hit the 0 to 100 miles per hour within 4 seconds. So that caught everyone's attention, especially on the premium market for the sport car segments, right? Then only after that, when these people start to get their hands into it, then at that point the proof of concept is already there. Then when only then Tesla start to hit the masses, and they start to receive a lot of complaints about not having enough charging stations, right? So at that point of time, Tesla is already ready, so they address that with their supercharged stations, and that essentially marked the points where the EV infrastructure start to take place and start to take the momentum, and that brings upon how EV has successfully penetrated into the US, into the traditional car segment in US successfully. So as for China, it's a slightly different story. From what I gathered, the penetration rate when it comes to China market, right, the penetration rate for a normal car is still very low at that point of time. That essentially when people buys car at that point of time, it's still they still hinges upon the convenience for them to bring you from point A to point B. So because the demand is so strong on the internal combustion cars, right? So the waiting period for the normal car, essentially, if I'm not mistaken, it goes up to 8 to 12 months. And then at the same time, we do hear that China also have air pollution issue at that point of time. So EV is being introduced to the market, and it's also being available to the market at a cheaper rate without a lot of the convenience of a normal car, like an aircon, or even like radio or all those added stuff like essentially. So the main focus of EV at that point of time is more of to bring you from point A to point B. So even some of the municipal also offered some form of subsidy to get people to shift from normal car to buying the EV. So since municipal is promoting it, they are building the infrastructure. So that's how essentially we see that the EV market managed to successfully penetrate into the China market. So when we bring this back to Malaysia, right, as you mentioned, it's still very early stage. We don't have a lot of charging station. Most of the charging station we see nowadays is going to be at the malls or even some petrol station, but it's still very limited towards Klang Valley areas. So for people to actually buy EV in Malaysia, it's more of a replacement car rather than buying a car for you to get you from point A to point B. So for now, if your point A to point B is still within KL area, so very likely that for you, it's quite okay for you to shift to EV. But if you're a person that would go like balik kampung, like let's say to Terengganu, right, you don't want to drive all the way to like Kara Highway, then you just stuck there because there's no charging station anywhere along the Kara Highway or even all the way the LPT to Terengganu lah. So that's why it's more of a reason why people change their car at this moment. So until for me, in my view, until the infrastructure of the charging station is being introduced more widely in Malaysia, we might not see EV being taken off in a big way yet, essentially. Yeah.
All right, thanks, Farhana. Gan Leong, we know the budget is coming up. Do you think there will be any, good news for the EV in Malaysia?
Well, I never hear anything, but I suspect that they are going to maintain whatever exemptions they give to the electric vehicles right now. I think right now they're exempted from any duties, right? So from my standpoint, earlier Farhana, I agree with Farhana that, I think that for Malaysia, the adoption of EV is a bit different from what we see in China or even America. So number one, we lack the infrastructure in place, and there's just not enough electric vehicles on the road to encourage companies or people to invest in the infrastructure. Number two, of course, again, I think in China right now, when about 24%, if I'm not mistaken, about a quarter of the cars in China is actually electric vehicles or hybrid vehicles, compared to about 7% in America. But over time, they do intend to. I think Europe intend to go fully electric. I think America intend to go 50% electric. So eventually, it will have to come. Eventually, when people start to move, try to encourage more electric vehicles, I do believe Malaysia will follow suit. But the biggest obstacle in Malaysia would actually be your petrol subsidies, actually. So in America, when gasoline prices keep going up, people are rushing to buy electric vehicles. In China, same thing again. There's just Malaysia, with the type of subsidies we get, with RON 95 at this level, people are not pushed to go, change to electric vehicles. But imagine if your petrol prices, go up 3 times what it is right now, then you will put in more consideration into buying an electric vehicle. So that subsidy alone itself is actually, a challenge actually to convince Malaysians to actually convert from the traditional combustion engine to electric vehicle. And over time, if the government slowly remove the petrol subsidy, then yes, I do believe that there will be more electric vehicles on the road. As for, I think earlier the question where, BYD building factories in Thailand, I think, Thailand have always been seen as an automotive manufacturing hub. So, by default, I do a lot of companies or, at least global automotive firms, when they were to decide to expand, they will consider Thailand first. It's like how we, Penang, it's seen as a semicon hub as well. So I think each have its own but on the EV side, I don't see any more additional incentives that the government can give right now, other than just making it duty free .
All right, thanks Gan Leong. Jidun, do you see any growth on EV in Asia Pac?
I think the short answer is yes, right? So if you look at Asia in general, and if you just break up into the different regions, I think if you look at China, China is obviously at the forefront, right? Close to 50% of all electric vehicles that are produced in the world are actually all in China. So China is definitely right at the forefront, and they are lucky from the perspective that there's quite a fair bit of quite a few EV only car manufacturers that are all China based, the likes of Li Auto, XPeng, NIO, those guys are all China based, so they know exactly what the Chinese people want and what the Chinese people need. And obviously, I think Farhana have spoken a bit about in terms of infrastructure needs, how far do you need to travel, is it for long distance, short distance? So they are well aware of that. And also in terms of China, the EV value chain is very, very well established in China. They have some of the best battery guys in the world that are based out from China, and a whole slew of other complementary subsectors that support the entire EV sector. So China, for one, I think we are very, very positive on the take up of EV. And also in general, our view is that I think EV have reached a point whereby in a lot of countries, it has moved from being a niche sort of a fun car to drive to something that is more mainstream, right? In terms of the number of models that we are monitoring, I think last year globally, I'm talking about globally in general, last year there were about 80 new EV models, but this year that numbers have gone up to about 200. There are 200 new EV models that are being launched in the world. And also more significantly, right, a lot of these new EV models are launched by the traditional car manufacturers. I mean, I'm talking about the likes of your Toyota, your Honda, your Mercedes, your BMW, and all of that, right? It's not just by the niche EV manufacturers. So we are starting to reach a point whereby I think the traditional car manufacturers have made confirmed commitments. I think we have a few of the ones that are leading the pack, like things like VW, Volkswagen. They've come and said that by a certain date they will not be producing any internal combustion engine cars anymore. So there's firm commitment on that part, and I think related to what everybody's talking about, we need a variety of supporting policies to cause an inflection point, right? So I'm just taking the case of Singapore, for example. I think there have been talks that they might make it a policy, or they might change the regulation to ensure that if you are building new condos or new property, they need to have a minimum number of EV charging station, right? So we are talking about I think the government have to play a part in that, and maybe some form of PPP, public-private partnership, in terms of trying to roll out the charging infrastructure, because it's a chicken and egg issue, right? So if there are so few EVs, then the initial charging station will not be making money. If there's not enough charging station, then why should people buy EV, right? So I think we need I think the whole industry is well aware that there needs to be a holistic solution to this conundrum.
All right, thanks, Jitun. Back to Malaysia. The Prime Minister has recently said that Malaysia can play an important role as a digital investment hub in ASEAN. He also mentioned that Malaysia has potential to achieve 70 billion in investment by 2025. And what are your thoughts on it, and which sectors do you think will benefit from it? Gan Leong?
Okay, so I think when it comes to this type of digital investments, I think we are far behind Singapore in that sense. But of course, time and time again, our government always, they come out with statements like this that say, we can be at the forefront of this and that. I always take it with a pinch of salt. Okay, so from what we see right now, I think the closest that I've seen is probably the in the cryptocurrency end, what's going on with Luno, where our SC start to allow them to do more, but then nevertheless, I just don't see us being a big player in this field. So I have nothing much to comment on that.
All right. Thank you, Gan Leong. Farhana, how about you? Anything on this? So, Farna, we cannot hear you.
Sorry.
Yeah.
I thought okay, so from our point of view, essentially we look at this as nothing new, because if we go back into history, right, we have that multimedia super corridor, which is stand MSC for short, right, which now changed to become a Malaysia Digital Initiative. So MSC was originally designed to be a comprehensive strategic plan with ultimate objective of converting the old system to the new, updated, and also advanced IT systems, right? But and even until today, we've seen that some of the testing when it comes to even 5G, right, is still being carried upon within this vicinity as well. So the goal of MSC earlier is definitely to bolster the IT industry in Malaysia, right? Then now it changed into the Malaysia Digital Initiative, which will sort of like supersede this 25 years old MSC, as it aims to enhance the country's digital capabilities and boost the national digital economy. So even like previously, especially for us, when we look into the whole situations, right, the whole IT and also technology related company, right, so far for sure is definitely going to be the winner when it comes to this initiative for investments, right? But I would say that to a certain degree, I can say that thanks to COVID, digital transformation is actually happening across the board. So essentially, when it comes to digital investment, I would probably put it in a manner where everyone can be benefited out of it. So because essentially we have seen a lot of innovation has been uptake on the remote and also home-based working, right? Because it's triggered by the COVID-19. Then we see a lot of a new infrastructure has been built on when it comes to software and also hardware development. Then we also see a lot of new development or achievement we see on deep learning and also big data and also other AI technology, which essentially is not just purely focused on the technology space, but it's being adopted across areas where it actually being adopted into the gaming industry, into the advertising industry. Then even to this day, the full scale of application and also the full scale of benefit out of all these technologies, right, is still under studies. Essentially, we have not yet meet the full scale of all these technology revolutions, like essentially. So we see this as an extensive of, to a certain degree, I were to give an examples, right, when it comes to like things like deep learning, big data, or even AI, right, in the process of making the vaccine for COVID, that big data, deep learning essentially helps in the process of vaccine making for COVID, which now that the same technology is being used on developing treatment for cancer. Then another simple case use that I can share is like not big data, is deep learning mechanism was used on finding the best possible combination for chemicals on existing combination of chemicals for IKEA white furniture coating. So if you see the IKEA white furniture today's, right, it's becoming more durable and also it becoming less likely to stain, and essentially the white color, right, it can last longer because the combination of chemical actually use deep learning to find the best possible combination. So it's not necessarily just IT, but other parts of sectors also would definitely benefit when it comes to digital investment hub. When it comes to pursuing of digital investment hubs, essentially. Sorry.
Thanks, Farana. Talking about digital, what about the development of 5G in Malaysia? Kan Leong?
Hi, yes. So I do believe on that end, we will move through it. I think recently our finance minister did throw an ultimatum to, the big telcos who actually refuse to, opt in, right? That, if they don't, they'll just invite foreign players to come in, which I do believe that that's the right thing to do. If you actually, I think most people will agree with me. Telcos have been under investing in their OPEC recently in their maintenance. Hence why, time and time again, we are facing, despite, we are supposedly to have, stable 4G, we couldn't even get it most of the time, we always lose lines. I think that's one day that I think half of Klang Valley, didn't, if you're using Maxis, right, you couldn't get any connection at all. So I do believe that the government will push through with it, and I think they're taking the right initiatives right now to force them that they have to opt in with this 5G, that, this DNB, you're not going to, you cannot run a separate scheme, you cannot run a separate entity to for 5G, and I think things will flow through quite quickly. So I do believe that, it's the right thing to do, what our government is doing with the DNB.
Thanks, Kai Leong. Our next question is on oil and gas. OPEC recently agreed to lower the oil output to maintain the oil prices. What are your thoughts on this? Will OPEC continue to lower the supplies, and what will be the impact of this to Malaysia and the rest of the world? Jitun?
Okay, so I guess from my perspective, I can talk a bit about how this will affect Asia and I guess the world in general. I think from OPEC perspective, they will obviously think about from their own perspective and from their own interest. I think the recent weakness in oil prices is obviously causing them to sit up and take notice. But however, I think the recent oil price volatility, can be attributed to the recent general macro weakness, possibility of recession in the US and other parts of the world, especially in the West. I think China has been locked down intermittently again. And last but not least, obviously, there's some talks about on the oil price side whether there's going to be a Russia oil price cap, and also some possibility of a Russia of a US-Iran deal, right? So all this is probably provides the backdrop in terms of their recent discussion on what to do with the oil price production. So at the end of the day, right, I think there's been a cut in the oil output, but however, it's symbolic more than anything else, right? Even though there was a cut, but it's very, very minimal, right? So but it does send a signal that they want to keep oil prices at a certain level. So why 90s is something, a 90 handle is probably something that they would be comfortable with, and it's probably of their view that that's a level whereby I think the world in general are able to take, right? So this is something that I think gives us extra comfort, at least for our portfolios, for RHB asset management. We continue to be very supportive. In fact, with the recent downturn in the oil prices, we have started to pick up some of the oil stocks as well. I think that gives us a bit of opportunity to pick up stuff that we really like, because at the end of the day, our view over the longer term is that over the course of the last few years, I don't think there have been enough increase in supply in terms of oil production due to a variety of issues, namely because of COVID, because of ESG issues. It's becoming very difficult for the oil majors to increase their capex into oil production. So that provide us a kind of supportive scenario, at least from a supply side. And also on the demand side, it's important to highlight that China is obviously not in the equation at all with the lockdowns that we have seen. Chinese people are obviously not traveling outside. Obviously, we know that the lockdowns is in fact deflationary in nature to a lot of asset classes, just because that the curbing of demand because of the lockdown would put a downward pressure on the commodity prices. So that is something that we think will probably change in the foreseeable future. I'm not trying to say that obviously China is going to lift their zero COVID policy tomorrow, but I do think that progressively, right, it should be moving in the direction of more loosening. So with that as a backdrop, I think we continue to be quite supportive of the oil sector. And the other thing, obviously, the elephant in the room is obviously the Russia-Ukraine war, right? So anything can happen there. Obviously, there have been some recent setbacks in terms of the Russians' initiative. but I think they will obviously try to fight back as much as they can. So that part, the geopolitical part, continues to weigh on the market. And I think for us, I think it's an interesting way for us to play the geopolitical volatility through the oil complex.
Thank you, Jitun. Gan Leong, how about you? Any opinion on this?
Yeah, so I think I agree with Jitun on this. I do believe that they want oil prices to be at least $90, and I would see that there's more upside potential for oil than downside risk at this juncture. Number one, as mentioned by Jitun earlier, that China is slowly loosening up. So as the economy start to reopen, mobility trends will trend higher. So that will drive the oil consumption. On top of that, I think why did the OPEC actually wanted to reduce the oil output to prop the prices is mainly because they think that there's a significant divergence between what's actually happening in the actual market and the financial markets. So oil prices started to tank because you have a lot of speculators, traders coming into play where they think that US Fed's going to increase interest rate aggressively, which is going to cause a recession, which will lead to lower oil consumption, and then that piles down on oil prices. And then not only that, lately, there are just so many momentum hedge funds out there, algo traders, so they ride on momentum. So when the oil prices were trending lower, more bets on oil pile up, and then that's why it declined very quickly. So I think what OPEC wanted to do is, they wanted to, at least put a stop on it, because on the actual market itself, demand is still strong. If you talk about gas, extremely strong. Gas prices is still actually is at its high. Coal prices are at its high. So it makes no sense why oil prices are so much lower than its peak of 130. So I think that they saw the divergence there, and they think that there's a lot to do with the financial markets. Hence, the intervention came along. But nevertheless, I do believe that what oil is trading right now is actually where it was trading before the Russian-Ukraine invasion. So I think that downside to oil prices is extremely low at this juncture. So like Jitun, we also have been increasing our exposure to the oil and gas sector. We do believe that in the coming years, the geopolitical risk will still be there, and we think that we are starting to see higher capex spending in oil and gas expenditures, and that should drive the whole industry as a whole. So we took this opportunity to actually increase our exposure in this sector during this period.
Thank you, Gan Leong. We have one question from the floor, and this is dedicated to Jitun. If we were to invest into the IHP China Enterprise Fund in 1 to 5 years before, is it possible for the fund to rebound, and what is your strategy in the future?
Okay, then that's a very good question. So I do think that if you think about the future prospect of China, I think it's inevitable that China will continue to grow and continue to grow strongly. I think the main reason why US is so nervous about China is also that I think China has taken over the lead in 5G especially, and that's why Huawei was also heavily involved, right? So all of a sudden, I think US just woke up one day and decided that, oh my goodness, then they realized that 5G, China is leading the pack, and not only that, China can do it better and also cheaper by 20 to 30% on the 5G infrastructure space. So if they don't do anything about it, then China would dominate, right, in future technologies. I think that was a key catalyst there. So I'm trying to provide a background, and I think the reason why they are so nervous, like I said, is that they realize that China is obviously catching up. I think we have come to an era, and I call it an era because the US-China tension is here to stay, right? Going back to so-called the good old days whereby everybody is so friendly, whereby World Trade WTO is so warm and fuzzy and everybody trying to help each other out. And, I think those days have long passed, right? Since Trump came back into the picture, we have seen the rhetoric increase. In fact, going into the November midterm elections, I think that will start to increase. So this is the anti-China feeling is something both the Republicans and Democrats can agree upon. So this will be the platform whereby they will try to drum out as much votes as possible, right? So our view is that I think it's inevitable, despite whatever US is doing. I think it's mathematical. It's mathematical that China will become the biggest economy in the world by 2030 something, 2035 or thereabouts, right? Because China will grow at anywhere between 4 to 5% or even sometimes higher, whereas US is going to grow at 2-3%, being a developed economy, right? So I think it's inevitable. So what I'm trying to say is that I think the long-term prospect of China continues to be there, right? And whatever US is doing, they're getting nervous and all of that. I think this is history playing itself out, right? It's always history. Has always have numerous stories whereby the rising power will starts to worry the existing superpower, right? And so we are living in this current era right now. And for our strategy, right, we are embracing it. Embracing it, meaning that we are not hoping that China-US tension will disappear. Because I think it would be naive to think that that will happen in the foreseeable future. So in fact, that's why for our portfolios, we are embracing this tension, meaning we are trying to find companies, sectors that will do well precisely because of this tension. And a few key highlights that I can point out to would be a lot of this China localization story, right? There will be a lot of Chinese companies which are probably a bit small right now, a bit relative at least to their global or US counterparts who are small right now, but these guys will grow. The reason is because a lot of this technology or a lot of these companies will not be able to use US or European technology, so they have to turn to their own Chinese suppliers to supply that kind of technology. So a lot of these companies will prosper precisely because of this US-China tension. So we are talking about self-reliance, we're talking about localization. So these are the stuff that I think will drive the Chinese market higher and higher. And not only that, we have spoken a bit about the relaxations of policies that we can see in the Chinese internet sector. So over the course of the last 18 months or so, I think the Chinese internet sector is obviously a significant part of the Chinese economy that roughly accounts for about 30% of the MSCI China benchmark. So that's been under a fair bit of pressure because of some top-down policy. And we have come to a stage whereby that top-down policy has reversed itself, right? So as a result, I think their fortunes going forward will be very different from what we have seen over the past 18 months or so. And also more importantly, I think Farhana, I think Dan Leong have also spoken about this. I think the MPC, the coming election or the continuation of Xi Jinping for his third term will be very significant. I think with that, once that is being confirmed, then we can see the focus being refocused on growth in China, right? So I think it's just a matter of time. So I do think that these are the things that we can look forward to over the course of the next few quarters and next few years.
Thank you, Chee Tun. We also have one question dedicated to Gan Leong. Apart from increasing exposure in oil and gas sector, what is CAF's strategy in the Malaysian market, or what are the other sectors that CAF is positive on?
Okay, so on top of increasing our exposure in oil and gas, we have recently also slowly increased our exposure into the Malaysian technology sector. I think in the past, when during the early tech sell-off in the start of year, our tech exposure were actually at a single digit of our portfolios. But right now we have slowly increased it to double digits, and we intend to continue increasing our exposure into the technology sector if there's an opportunity that arises. The reason so is because we think that number one, the ringgit may continue to depreciate or at least stay weak against the dollars, because we do not see that the Malaysian Bank Negara is capable of keeping up with the pace of increase that we're going to see by the US Federal Reserve. Hence, we anticipate that there may be a further sell-off in emerging market currencies. And that, if we look at it from that perspective, then in Malaysia, the technology sector, again, a lot of the some of them or most of them actually price their products in US dollars. That should benefit them. And we do believe that, institutional fund managers in Malaysia are highly cashed up right now because, of recession fears. So if they were to decide to go back into the market or deploy their existing cash reserves, we think that, the tech sector may be the most enticing one due to its growth prospects. And also, I mean, from a simplistic manner, you look at year to date, I think the Malaysian tech sector is down more than 30%. So by itself, it should attract, more institutional funds if they were to decide to deploy the cash that they are holding right now. So these are the two sectors that we like a lot right now, the tech sector and the oil sector, which, accounts to probably 30 to 40% of our portfolios.
Thank you, Gan Leong. I have one last question, a casual question, that's on the market sentiment. 1 to 10, 1 being the least risky and 10 being the most risky. What do you think, what rating will you give for the current market sentiment? Probably we start with Farhana.
Wow, because at the moment we still have that FOMC meeting ongoing. So it really hinges upon that. But at current moment, for my team, essentially we still hold a neutral view on the market, as essentially at least until towards year end of this towards year end this year, essentially. So especially for my Malaysia market, we still see Malaysia market to end at least 1540 at level of 1541, and at the same time that is hinges upon of a scenario where we think that when it comes to the US market, it's still gonna be a disinflation market and also strong economy still holds. So if I were to give rating neutral, probably 5.
Okay, thank you, Farhana. Jitun, how about you?
Okay, let me answer the question in another way. Okay, so right now, obviously, I think the fact that we have this question means that I think everybody out here is well aware that the market sentiment is obviously very, very weak, right? So if you ask me what is the market sentiment out there, I think it's very weak. On the scale of 1 to 10, whereby 10 is super bullish, 1 is like the whole world is going to end, we are probably at a 4, right? We're probably at 4, 3.5 or 4, because the market is indeed very weak. I think that everybody is very worried about a variety of things, right? But I think the more important question is, it's not just about the market sentiment, right? The other more important part is what is the valuation, right? If the market sentiment is so weak, but the valuation is so attractive, then for those of us who are willing to stick it out and then maybe just ride it over the medium term, I think there's a lot of value to be had in the market right now. Because even though, like I said, I think, throughout the entire today's panel, I think you can see quite clearly that I think overall sentiment-wise, I think all three panelists have highlighted that I think the market sentiment is obviously very weak. But the other thing is also want to highlight is that I think the valuation is very, very attractive at this point in time. So we do have to weigh both, right? So just talking about market sentiment, I think we're missing a big chunk of what is also very important, which is the valuation, right? I think having weak market sentiments, having weak cheap valuation, I think that makes for an interesting combination, right? It does give us a very good entry point for a lot of the stuff that we would like to buy and we can hold for the foreseeable future. So I think I will answer the question in that manner.
Thank you, Jidun. Gan Leong, how about you?
So basically from my standpoint, I will separate it into two segments actually. So you got your institutionals and your retailers. So I think the rally that we have seen from the lows recently in America was actually driven mainly by retailers, whereas the institutionals are still very bearish. I think the tone is bad, the sentiment is really weak right now. The idea here is, they always say don't bet against the Fed, don't bet against the Fed. And now the Feds are increasing interest rate at a very rapid pace. So again, on a relative basis, in general, that is very bad for equity markets. So if you ask me, in the near term, I am bearish of the markets. I think that, okay, it's going to, there will be volatility, there will be ups and downs. I mean, even in bear markets, there are short rallies, but nevertheless, I would say that the market was stay sidelined for a while, at least until the Fed's slow down its interest rate hikes, or even potentially not hike interest rates anymore. So from that standpoint, I would say that the next 6 months, I'm still bearish the market. I think sentiment's bad, and I think it's quite risky in general. So 1 to 10, maybe 7, for the riskiness, on that barometer that you've given me. But nevertheless, past that, of course, once the interest rate have reached normalized levels, I do believe that markets, there will be pockets of opportunities. I agree with Jitun earlier that if an investment opportunity do arise because the valuation is very attractive, we will not hesitate to deploy our cash and make these investments, because we don't invest for 3 months or 6 months. We take a longer term horizon when we make our investments. So yeah, we are constantly looking for opportunities. I would not tell you that I'm just going to hold cash and not do anything. If an opportunities arise, and every day we are looking for these opportunities, there are sometimes at times there will be certain stocks that get sell aggressively, and we may build a position on these stocks.
Thank you, Gan Leong. That was actually our last question. To wrap up, while there are risks in the current market, which is a norm for the stock market, what we are experiencing now is just a path of normalization from distortion. Just as no market can go up forever, it won't fall forever. So stay invested. This is the end of our roundtable session for today. We are grateful to have Mr. Tan from IHP and CAF, as well as Ms. Prana from Phillip Research for their valuable insights. Goodbye, and stay tuned for our next roundtable.
Thank you, everyone.
Thank you very
Stay
much.
safe.